The credit card has become an essential part of our daily financial transactions. They offer convenience and flexibility, making it easier to manage purchases and payments. But have you ever thought, what is the story of these credit cards and how their technology and computing have transformed so much? Don't worry, in this video, we will tell you the evolution of credit cards from their early beginnings to digital currency as they are used today. Make sure you subscribe to our channel and press the bell icon to get regular updates. Let's get started. The early beginnings. The concept of credit dates back to ancient times when merchants extended credit to trusted customers. However, the first credit card-like tool appeared in the early 20th century. In 1914, Western Union introduced the first metal card, which allowed select customers to delay payment on their purchases. These cards were mainly used for travel and entertainment expenses and were not widely available. In the 1920s, various U.S. department stores and oil companies issued their cards to loyal customers, allowing them to make purchases and pay later. These early credit systems were limited to specific stores or services and required customers to pay off the balance in full each month. While these cards were not credit cards in the modern sense, they laid the groundwork for the development of more versatile payment tools. The birth of the modern credit card. The modern credit card began to take shape in the mid-20th century. The very first credit card that could be used at many places was given by the Diners Club in 1950. In the beginning, it was accepted in 27 places in New York City. The Diners Club card was a charge card, which meant that all amounts had to be paid off every month. The idea of multi-use came into being during this time, even though it had a limited range. American Express joined the market with its card by releasing a similar product in 1958. This made the market bigger. American Express, on the other hand, wasn't just aimed at one group like Diners Club was. It was also aimed at business leaders and travelers. The card quickly gained popularity, and by the early 1960s, it was being used all over the world. American Express also made a plastic card that was better than the metal cards they had before because it was more sturdy and easier to use. The expansion era. The 1960s and 1970s saw rapid growth and innovation in the credit card industry. In 1958, Bank of America introduced the Bank AmeriCard, which eventually evolved into Visa. This card allowed customers to carry a balance from month to month, a significant shift from the charge card model. The concept of revolving credit, where cardholders could pay a minimum amount and carry the remaining balance with interest, made credit cards more accessible to a broader audience. During this period, other major players entered the market. In 1966, a group of banks formed the Interbank Card Association, which later became MasterCard. The competition among these companies spurred further innovation. The introduction of magnetic stripes in the 1970s enhanced security and facilitated electronic transactions. Magnetic stripes store cardholder information, allowing for quicker and more secure processing of transactions. Another key development during this era was the establishment of credit card networks and payment processors. These organizations, such as Visa and MasterCard, created the infrastructure that allowed for the widespread acceptance of credit cards. They connected banks, merchants, and consumers, enabling seamless transactions across different locations and even internationally. Technological advancements. The late 20th and early 21st centuries witnessed significant technological advancements that revolutionized the credit card industry. The introduction of chip technology known as EMV, Europay, MasterCard, and Visa in the 1990s enhanced card security by storing data on a microchip rather than a magnetic stripe. This technology significantly reduced the risk of counterfeit fraud, making transactions safer for both consumers and merchants. The rise of the internet and e-commerce in the 1990s and 2000s also transformed credit card usage. Online shopping became increasingly popular, and credit cards were the primary payment method. Companies developed secure online payment systems, and features like one-time passwords, OTPs, and two-factor authentication, 2FA, were introduced to enhance online transaction security. These measures provided an additional layer of protection against unauthorized use of credit cards. The emergence of rewards programs. As competition among credit card issuers intensified, companies began to offer rewards programs to attract and retain customers. These programs started in the 1980s with cashback and travel rewards, but have since evolved to include a wide variety of incentives, such as points for merchandise, discounts, and exclusive access to events. The rewards programs were designed to encourage cardholders to use their credit cards more frequently. For example, frequent flyer programs offered miles for every dollar spent, which could be redeemed for airline tickets. Similarly, cashback programs provide a percentage of the purchase amount back to the cardholder. These programs became a key differentiator for credit card companies and a major factor in consumer choice. Over time, rewards programs became more sophisticated and tailored to individual preferences. Card issuers partnered with various merchants and service providers to offer specialized rewards, such as discounts at specific retailers, dining rewards, and even access to concerts and sporting events. The ability to customize rewards based on spending habits and preferences became a significant selling point for credit cards. The role of regulation. The rapid expansion of the credit card industry also brought about increased scrutiny and regulation. Governments around the world implemented laws and regulations to protect consumers from unfair practices and ensure transparency in credit card agreements. In the United States, the Truth in Lending Act of 1968 required lenders to disclose the terms and cost of credit, including the annual percentage rate and fees. In 2009, the Credit Card Accountability, Responsibility, and Disclosure Card Act was enacted to further protect consumers. This legislation aimed to eliminate unfair practices, such as sudden interest rate hikes and hidden fees, and to provide clearer information about credit card terms. The Card Act introduced several consumer-friendly provisions, including restrictions on interest rate increases, clearer billing statements, and more time for consumers to make payments. Similar regulations were adopted in other countries to promote fair practices and enhance consumer protection. For example, the European Union implemented the Payment Services Directive (PSD) to create a harmonized framework for electronic payments, including credit cards. These regulations aim to increase competition, improve security, and provide consumers with more transparent information about fees and terms. Digital wallets and mobile payments. The rise of smartphones and mobile technology in the 21st century introduced new ways of using credit cards. Digital wallets such as Apple Pay, Google Wallet, and Samsung Pay allow users to store their credit card information on their mobile devices and make payments with a tap or scan. These mobile payment systems offer convenience and security, as they use encryption and tokenization to protect card information. Contactless payments, where cards or mobile devices are simply tapped on a terminal, have also become increasingly popular. This technology, known as near-field communication (NFC), has further streamlined the payment process and enhanced the customer experience. Contactless payments are not only faster but also reduce the need for physical contact, making them particularly appealing in situations where hygiene is a concern, such as during the COVID-19 pandemic. Additionally, the integration of credit cards with mobile banking apps has provided consumers with more control over their finances. Users can track their spending, set up alerts, and even temporarily freeze their cards if they suspect fraudulent activity. These features have made managing credit cards more convenient and secure, contributing to the continued growth of credit card usage. The future of credit cards. The evolution of credit cards is far from over. As technology continues to advance, the credit card industry is likely to see further innovations. Artificial intelligence, AI, and machine learning are being used to improve fraud detection and enhance customer service. AI algorithms can analyze spending patterns and detect unusual activity, alerting cardholders and preventing potential fraud. Biometric authentication, such as fingerprint and facial recognition, is being integrated into credit card systems to provide an additional layer of security. These technologies offer a higher level of security compared to traditional PINs and passwords, making it harder for unauthorized users to access cardholder information. The growth of cryptocurrencies and blockchain technology also opens up new options for credit cards in the future. Some businesses are looking into ways to accept cryptocurrency as payment, which would let users buy things with digital currencies. Blockchain technology could also make deals safer and more open by keeping a decentralized record of them that can't be changed. The creation of virtual and digital-only credit cards is another area that could grow. You can only get these cards digitally, and you can use them to buy things online and on your phone. For example, they offer temporary card numbers for one-time purchases, which makes security better and lowers the risk of fraud. Virtual credit cards are also better for the earth because you don't have to use plastic cards. That's all for now. I hope you have enjoyed watching the video. Make sure you like and subscribe to Nick's Finance for more amazing videos. Thanks for watching till the end.